Hello, everybody. So this is the lecture associated with Chapter 1, at least the first part. So the video for Chapter 1 will be broken into several parts. So Chapter 1 here is comes after Chapter 0, so it's not the first chapter of the course. So before we start the chapter, I want to thank Mathieu Corriveau-Lagrenade since some parts of this chapter were inspired from his class notes. So in this chapter, we will introduce financial derivatives. So we will study what they are, what are the payoffs or the cash flows associated with these financial instruments, and the objective of introducing these is to study their valuation and their use in risk management for financial institutions in subsequent chapters. Okay, so financial derivatives we will see are extensively used by financial institutions to manage their risk. So it's very important to understand in practice how they work. And to understand their behavior, it requires studying some quantitative finance models. Okay, so the previous chapter was very non-mathematical. This one has some mathematics, but less, maybe less than subsequent ones geared towards valuation. Okay, so we're slowly going to phase in mathematics in the course. So, what is a financial derivative? Well, its definition is that a financial derivative, or sometimes simply called a derivative, is a financial contract between two institutions whose value is determined by the value of another asset called the underlying asset. Okay, we'll give more specific examples. Right now, that might be a bit abstract, but we'll give specific examples very shortly. In this course, we will study two main types of derivatives. The first type is forwards or futures. So these contracts are pretty similar, but they have some differences. So we will introduce these later on. And finally, options. So the first derivative we're going to study is a forward contract. So what's a forward contract? It is an agreement between two institutions which forces the first one to buy some asset from the second at a predetermined date and a predetermined price. And the name of the asset is called the underlying asset. So the first institution which is forced to buy the asset in the future is said to have a long position on the underlying asset, whereas the second institution, which will be forced to sell the asset in the future, has a short position on the asset. The predetermined price at which the transaction will take place is called the strike price, and the date at which the asset will be traded is called the maturity date. What are possible underlying assets for forward contracts in practice? Well, there are many possible underlying assets in practice. There are uh, equity, so for example, stocks, financial indices, etc. There might be fixed income assets such as T-bill, treasury bills, corporate bonds, etc. There might be commodities, natural gas, oil, electricity, wheat, metals, and there might be foreign currencies, so currencies of various countries around the world. All these can be underlying assets of some forward contracts. So let's give an example. Let's say an institution A has agreed with an institution B to buy from the latter 5,000 bushels of corn to institution B on December 31st, 2018 for the amount of $25,000. So what would be the strike price here? It's the price at which the transaction takes place, which is $25,000. The maturity date is the date of the transaction, which is December 31st, 2018. So the underlying asset will be exchanged on that date. The underlying asset is 5,000 bushels of corn. The holder of the long position is institution A because it's the institution which will receive the underlying asset, and the holder of the short position is the institution B because it's the institution which will be forced to sell the asset in the future. So a bit of notation. K is often used here to denote the strike price. Capital T is often used to denote the maturity date. And S, small t here, will use this symbol to denote the underlying asset price at time small t. So we can define the forward contract payoff as the following. So for the long position, the position which will receive the underlying asset, we say that the payoff of the forward contract is S capital T minus K, which means that at the maturity date, the long position will receive the underlying asset, which will be worth S capital T on that date, and he will pay the strike price, which is K dollars. So on the maturity date, the long position will receive something worth S capital T and will give K dollars. Conversely, if you're the short position, then at the maturity date, you will receive the K dollars, and in exchange, you will be forced to give the underlying asset, which will be worth S capital T. Okay, so this defines the payoff of the forward contract for both the long and short positions of the deal, respectively. So this is a plot, well, in fact, two plots for the payoff of the forward contract at maturity for both the long and short position. So if we plot the function st minus k here, which is the payoff of the long position, we see that it's a straight line which crosses here k. So when st is equal to 0, when st is equal to k, the payoff is 0. If st is greater than k, then the payoff will be positive. If st is smaller than k in this area, then the payoff will be negative. And the slope here of the straight line is exactly 1. Conversely, for the short position payoff, the payoff function is k minus st. So if we plot that function, this is simply a straight line starting at k when st is equal to 0, S capital T, and going down with a slope of 1 indefinitely. Okay. So in a forward contract, we can sometimes talk about the settlement mode or type of settlement, and there might be two possible types of settlement for a forward contract. The first one is what we call physical settlement. This means that at the maturity date, the underlying asset is delivered physically. So for example, if your underlying assets is serial, then at the maturity date, the short position will ship the serials to the long position. The second type of settlement is called financial settlement. So instead of shipping the serials, in a financial settlement, the short position would pay S capital T dollars at maturity. So let's say the cereals are worth $2,000 on the maturity date. In a forward contract that is financially settled, the short position will send that amount of money to the long position instead of shipping the cereals themselves. So sometimes it might be more convenient to send the value of the underlying asset in dollars than the underlying asset, because sometimes shipping the underlying asset can be pretty costly. So another remark about forward contracts, we said that at the maturity date, the long position receives the underlying asset or its financial value and pays the strike price. But before that date, there are no cash flows associated to a forward contract. So in a forward contract, all cash flows are strictly provided at the maturity date. So one question we might ask ourselves is, how is the strike price determined in practice for a forward contract? So when there are two institutions which agree to sign a forward contract, how do they decide on K? So this looks like a subjective choice. Okay, you might think that K depends on expectations for the price of the underlying asset in the future. This is subjective, but we will see next that under some assumptions, there will be only one single sensible choice for the strike price. Okay, so we will see that under some assumptions, this strike price should not be subjective. There's only one value that would make sense for it. Okay, so to discuss this value, first we will need to introduce some concepts, which are the concepts of arbitrage and short sales. So first, what's a short sale? A short sale consists in selling an asset you currently don't hold. Okay, so how do you sell something you don't have? Well, you first have to borrow it to a third party. Okay, so you borrow at some point an asset from a third party and then you can sell it, but because you borrowed that from the third party, in the future you'll have to purchase back that asset to return it to the third party. Okay, so you're selling something right now, promising that you will buy it back in the future to return it to the third party. This is how a short sale works. Furthermore, if there are dividends paid by the underlying asset during the duration of the short sale, they must also be reimbursed to the third party from which the asset was borrowed. Okay, so let's say, for example, you want to sell short the stock of Microsoft. Okay, so you want to sell the stock of Microsoft because you feel it's overpriced, but you don't currently hold the stock. So what you will do, you will borrow the stock from a third company, sell it on the market, and then eventually in the future, you'll purchase it back in the market at a time where you hope the price will have stabilized or be more in line with your expectation, and then return it to the third party. But if the Microsoft share paid dividends between the day at which you borrowed and the day at which you returned the stock, then the person to whom you've borrowed the stock will not receive the dividends, okay, because he doesn't hold the stock during that period because you've sold it on the market. So to be compensated for that, the dividends will need to be or the value of the dividends will need to be returned to the third party by the person who borrowed the stock. Okay, so this looks like a lot of transactions. So I've made two quick charts to illustrate cash flows associated with a short sale. Okay, so at the initiation of the short sale, here are the following actions that are made. Okay, so the short seller, the person who wants to sell the asset he doesn't have, does the following. Okay, so he borrows the underlying asset from a third party, and then he uses this underlying asset and sends it or sells it to some counterparty in the market, and the counterparty provides to the short seller the value of the asset on the market. Okay, so for example, if on that date the Microsoft share is worth, I don't know, $500, then the short seller gives the share and the counterparty pays $500 to the short seller. So this is at the initiation date of the short sale. But then at a maturity date in the future, here's what happens. The short seller, because he borrowed the share from a third party, he must return the share to the third party in the future. So how does he do this? He first buys the share in the market from some other counterparty. So he goes to the market, buys the share. So the market gives the short seller the share, but the short seller gives the value of the underlying asset in cash at the counterparty on that future date. And then because he received the stock or the underlying asset, he can give it back to the third party. And as we mentioned, if dividends were paid by the underlying asset between the initiation date and the maturity date, these dividends here, as denoted here, they must also be repaid from the short seller to the third party. Okay, so this is a short sale. This idea is introduced because sometimes some people want to sell things they don't hold, so there has to be some mechanism where this asset is borrowed to somebody else to allow for such sales. Okay, so we discussed short sales. We will now discuss self-financing portfolios. Okay, so again, this will be necessary for the determination of strike prices from forward contracts. Okay, so we said we need to introduce some concepts. So now we're introducing the concept of a self-financing portfolio. A portfolio is said to be self-financing if there are no cash flow injections nor withdrawal from the portfolio except at the initial date where the portfolio it is set up. Okay, so in a self-financing portfolio, the purchase of assets is funded directly within the portfolio. Okay, so you never add money to the portfolio, you never withdraw money from the portfolio. So if you want to purchase new assets, let's say assets from class A in that portfolio, you'll first need to liquidate some other assets from, let's say, class B, then use the proceeds of the sale of class B assets to purchase assets of class A. Okay, so self-financing means you, except at the initiation of the portfolio, you don't inject nor withdraw cash from the portfolio. So every time there is a sale that is performed, or a sale or a purchase of assets that is performed in the portfolio, it needs to be funded respectively by the purchase or the sale of other assets in the portfolio. So this leads to the definition of what we call an arbitrage opportunity. So an arbitrage opportunity is a self-financing portfolio whose initial value is null, is zero, and whose terminal value, denoted V capital T, satisfies the two following conditions. First, at a future time capital T, it will be greater or equal to 0 with probability 1, and it will be greater than 0 with a positive probability. So some probability strictly greater than 0. Okay, so how can we interpret an arbitrage opportunity? An arbitrage opportunity is a way to make money, to potentially make money without taking any form of risk. Okay, so this is riskless potential profit. So you invest nothing initially at time zero, its initial value is zero, and then at a future time point, you're sure never to lose money. So the first condition says you will never lose money on that investment of zero, and you potentially will make some money out of it. Okay, so it's money coming from nowhere. It's a bit like magic. Okay, so arbitrage opportunity, if they arise, it's very good because it gives you free money. But the idea we will introduce next is that such opportunities, they should not uh, arise when we specify the characteristics of financial contracts. Okay, so for example, when two institutions will decide on the strike price scale of the forward contract, the price specified in the contract should not lead to arbitrage opportunities. Otherwise, it might not make sense. Okay, so we will discuss that more thoroughly next. Okay, so we've talked about portfolios of value zero. Okay, so you might be wondering, well, if a portfolio has a value zero, it just means that there's nothing in that portfolio. Well, it's not exactly true, so we'll give an example of what we mean by a portfolio with a null value. Okay, so for example, you could borrow $100 of cash at the bank, and you could use that $100 to purchase stocks. Okay, so in that case, what would be the value of the portfolio? Well, the value of the loan position is minus 100 because you have a debt of $100 to the bank, whereas you hold $100 worth of stocks, so the value of stocks in your portfolio is 100. Okay, so the total portfolio value is the value of the position in the stocks, 100, plus the value of the position in the loan, which is minus 100, so the total portfolio value is 0. Okay, but that doesn't mean there are no positions in the portfolio. It just means that the net value of all positions is equal to 0. Okay. So in general, when we'll propose the pricing models for financial derivatives, we will assume or presume the absence of arbitrage opportunities. Okay, so what is the rationale to make this assumption? So the rationale is that arbitrage opportunities, if they arise in practice, they're typically small, unstable, and temporary. Okay, so as soon as some investors notice the potential for arbitrage opportunities, then they start exploiting them, and as they start exploiting them, these opportunities disappear. Okay, so how come they disappear? It's because when people, let's say, they see an arbitrage opportunity which requires buying some of asset A, for example, then as investors exploit the opportunity, they will purchase some asset A, and the price of this asset goes up, and it will go up until the point where it's not profitable anymore to make the initial transaction, and the arbitrage opportunity will be washed away. Okay, so as soon as there's an arbitrage portfolio or arbitrage opportunity, people will start purchasing that portfolio, and the price of the portfolio, which is initially 0, because this is the definition of an arbitrage strategy, its initial portfolio value is 0. As investors start purchasing that portfolio, this will push the value of the arbitrage portfolio higher than 0, and then it's not an arbitrage opportunity anymore. Okay, so arbitrage opportunities, the assumption we make when we price derivatives is that there aren't arbitrage opportunities, and the reason we do that is that we hope that in practice these opportunities, when they arise, they will tend to disappear shortly as soon as investors start exploiting them. Okay, so in the long run, these arbitrage opportunities should disappear. Okay, so we mentioned that um, based on some assumptions, there would be a single strike price in the forward contract that makes sense. So what are these assumptions? Well, these are presented now. Okay, so the following two assumptions imply that the forward strike price is unique. So unique that there cannot be multiple meaningful strike prices. Okay, so the first assumption we make is that there are no arbitrage opportunities in the market. Okay, so the rationale for making this assumption has been discussed just a few seconds ago. The second assumption we're going to make is that the underlying asset is storable without cost. Okay, so meaning that it's possible to purchase and sell the underlying asset anytime and to store it without cost. And this must be true for any amount of time. Okay, so if we go back to the previous example where an institution has to buy bushels of corn, well, that might not fit this assumption because in practice, if you want to store corn, probably you need freezers, and then there are costs associated to this. Okay, so for these type of commodities, that last assumption doesn't hold, but we're going to see that for many financial instruments, for instance, this assumption is reasonable. So when the underlying asset is storable without cost, then we're going to see the forward price must be unique. Okay, so before giving the value of the unique strike price, which makes sense, let's introduce a bit of notation. So we're going to denote by Z small t capital T the time small t price of a zero coupon bond of maturity capital T. Okay, so what's a zero coupon bond of maturity capital T? It's a bond which pays exactly $1 at the maturity date capital T with certainty. Okay, so when we say with certainty, we assume that it's impossible that the borrower will default on the reimbursement of $1. This $1 will be reimbursed with probability 1. So here, the next theorem states what's the only possible strike price for a forward contract that makes sense under the previous assumptions, which were absence of arbitrage and the possibility to store the underlying asset without cost for an indefinite amount of time. Okay, so if the two latter assumptions are satisfied, then okay, and there's a third assumption in the theorem. Suppose that the underlying asset does not pay dividend. Okay, so if you, for example, if the underlying asset is a stock that pays dividend, then this theorem does not hold. It must be adapted for that. Okay, but so if the underlying asset does not pay dividend, then the only possible strike price for a forward contract is given by the following equation. The strike price must be equal to S small t, the value of the underlying asset at time small t when both parties agree on the forward contract, divided by Z small t capital T, which is the price of a zero coupon at time small t, the time at which the forward contract is entered, for a zero coupon maturing at capital T, which is the maturity date of the forward contract or the date at which the underlying asset will be exchanged for the strike. Okay, so this is the formula, this is the result, but next we will show why this must be the case. We'll give a formal proof for this. Okay, so we said that we must have the following relationship. We must have that K is equal to S small t divided by Z small t capital T. So to show that both terms must be equal, what we will do is we'll assume that they're not equal, and then we'll get a contradiction, which will mean that they must be. Okay, so the first case, which will lead to a contradiction, is what happens when the strike price is strictly greater than S small t divided by the zero coupon bond price. Then what we're going to show is that if this is the case, then there will be an arbitrage opportunity. And this is precluded by our previous assumption. Okay, so if we show that having this inequality implies the presence of arbitrage, then this shows that this is not possible. Okay, so assume that there exists, assume that this, then we will show the following strategy is an arbitrage opportunity. And what do we mean by the following strategy? It consists in setting up the following portfolio. It consists in entering a short position in the forward contract, purchasing one underlying asset share at time small t at the initiation date of the forward contract, and selling short S small t divided by Z units of zero coupon. Okay, so if we set up this portfolio and if we assume the above relationship, then what would be the cash flows of such portfolio? So let's look at all the transactions made within the portfolio, and we'll look at the net cash flow, which will show that the portfolio is an arbitrage opportunity. Okay, so if we look at the first position, we said that in the portfolio, we take a short position on the forward contract. The cash flow at time small t is zero because we said that in a forward contract, there's no cash flow before the maturity date. And then at the maturity date, as we've seen in previous slides, the payoff of the forward contract is the strike price minus the value of the underlying asset at that date, because the short position gives the underlying asset and receives K dollar on that date. The second transaction we considered in the portfolio was a long position on the underlying asset, meaning that you purchased one share of the underlying asset. Okay, so if you purchase a share of the underlying asset at time small t, your cash inflow is minus small t because you have to pay the underlying asset. But then at capital T, you hold the underlying asset. So if you want, you could liquidate your position and sell the underlying asset, and you would receive S capital T, which is the value of the underlying asset. Okay, so if you do that, then your cash flows are minus S small t at time small t, which is an outflow, and at the maturity date, you have an inflow of value S capital T. And finally, for the last position, we said we sold short an amount of positions of zero coupons, and the number of positions sold short, is the following term. Okay, so we said we're selling short ST divided by Z positions. So if we sell them short at time small t, we receive at time small t the proceedings of the sale. So we receive the number of shares we sell times the value of the asset we sell. And the asset we sell is a zero coupon. So at time small t, we receive the price of the zero coupon times the number of shares here. Okay, so if we multiply and divide by Z here, these two Z's cancel out. So we see that the net inflow at time small t is equal to zero here. Furthermore, at maturity, then we've sold some zero coupons, so we must purchase them back to return them to the third party at time capital T. So if we must purchase them back, then we must pay the number of shares to the market that we want to purchase times the price of the share. But what's the price of the share here? The price of the share is exactly 1. Okay? Because if you purchase on the market at time capital T, a zero coupon which pays exactly $1 right now, then the value of a product which pays $1 right now is $1. Okay, so the price at time capital T of zero coupons must be $1 per share, and the number of shares you must purchase is ST divided by Z. Okay, so to purchase back all shares of zero coupon, you must pay the number of shares here. So pay, the minus side is because you pay. Here's the number of share times the price of the shares, but the price of the shares is equal to 1. Okay, so here what happens, you can add all the cash inflows from all positions at the time capital T. You have K here, which goes here. Here you have minus S capital T plus S capital T, so these two cancel out. And then you have minus this quantity here, so K minus ST divided by Z. So recall, if we go back one slide, our assumption was that the strike was greater than ST divided by Z. So if the strike is greater than this quantity, it means that this number would be positive. So in that case, we would hold a portfolio which is worth 0 initially, but which has a payoff or a value that is strictly greater than 0 at maturity. So we see that this would be an arbitrage opportunity, and this was precluded by our assumption. So this proves that the original relationship, the original inequality here, K greater than S divided by Z, is impossible in practice. Otherwise, there would be arbitrage opportunities. Case number 2. So we said that K cannot be greater than S divided by Z, but now we will show that K cannot be lower than S divided by Z. Okay, so if this is the case, if inequality 3 is satisfied in practice, we will show that this will lead once again to an arbitrage opportunity, which was precluded by our previous assumptions. Okay, so assume that we have this relationship, this inequality here. Then let's consider the following portfolio, which consists in combining the following positions. Okay, so consider a portfolio which entails entering, sorry, there's a typo, it should be enter and not entrer. So enter a long position on the forward contract at time small t, sell short 1 share of the underlying asset at time small t, and then buy this amount, so ST divided by Z, units of 0 coupons at price small t, at time small t. Okay, so let's consider this portfolio and let's analyze the cash flows associated with this portfolio under the assumption of inequality 3 here. So here, what are the cash flows associated with each of the positions in the portfolio? So we said first position is a long position on the forward contract. So we said that before the maturity date, a forward contract entails no cash flow. Okay, so the cash inflow at time small t is equal to 0. There's no cash flow before maturity associated with a forward contract. And then at the maturity capital T, the long position receives the underlying asset and pays the strike price, which is K dollars. Okay, so it receives something which is worth S capital T, the value of the underlying asset. It pays K dollars, so its cash flow is S capital T minus K. Then, second position in the portfolio, which is the short position on the underlying assets. So you sell short the underlying asset. So if you do that, at time small t, you borrow the asset from somebody and you sell it on the market. So you receive the proceeds of the sale, which is the value of one share of the underlying asset, which is S small t. Okay, so you receive S small t dollars at the initiation of the short sale, but then at the maturity capital T, you will need to purchase back the stock from the market to return it to the third party. Okay, so to do that, you need to pay the value of the underlying asset share on the market. So you need to pay S capital T dollars because you purchase it at time capital T. And finally, the third position in the portfolio was a long position on the zero coupon at time small t. So we said that we purchased at time small t S divided by Z. So here, this is the number of shares. S divided by S divided by Z shares of the zero coupon. So your cash inflow here is minus because you have to pay the price of the zero coupons, minus the number of shares times the price of the zero coupon, and the price of the zero coupon at time small t is Z. Z small t capital T. Okay, so you've purchased the zero coupons, and then these zero coupons, they expire at time capital T. So at time capital T, they pay you exactly $1 per share of zero coupon. Okay, so because of that, at time capital T, you receive $1 times the number of shares you purchased, and the number of shares was S small t divided by Z small t capital T. So if you combine the cash flows of each of these positions, then at time small t, the total cash flow is zero. So this entails having a portfolio which initial value is zero. But then your cash inflow at time capital T is the following. So first, the plus S capital T and minus S capital T, they cancel out. So what remains here is the minus K, which goes here, and the plus this, which is the value received from the zero coupon. So it's the number of shares of zero coupon as divided by Z minus K. So if we go back one slide, our assumption was that this guy was greater than K. And if we have that, then the following portfolio is an arbitrage opportunity because at time small t, its value is zero, and at time capital T, its value is strictly greater than zero. Okay, so it's a way to make money by not investing nothing at time small t and be sure to obtain some profit at time capital T, which is an arbitrage opportunity. And this, we said, is precluded by our previous assumptions. So in a nutshell, we just proved that S small t divided by Z, first we proved it cannot be smaller than K, and now we just proved it cannot be greater than K. So if it cannot be smaller nor greater, it must be absolutely equal to K. So the consequence here is that K must be equal to S small t divided by Z small t capital T. Otherwise, this leads to arbitrage opportunity, which is precluded by our assumptions. Okay, so the unique strike price possible for a forward contract under the assumptions we've made earlier, such as absence of arbitrage opportunities, storability of the underlying asset, and absence of dividends paid by the underlying asset, is ST divided by Z small t capital T. And then we're going to give a name to that strike price. This is called the forward price of the underlying asset. Okay, the forward price at time small t of the underlying asset is denoted by F small t capital T, and this is S small t divided by Z small t capital T. Okay, so this value here is the only possible strike price for a forward contract that is entered into at time small t, and for which the transaction between the underlying asset and the strike will occur at time capital T. Okay, so this is called the forward price of the underlying asset, and it's denoted by F small t capital T. Okay, so we talked about the storability assumption uh, made for the underlying asset. Okay, so what happens if this storability assumption does not hold? Well, what happens is that some of the steps from the previous proofs now don't hold anymore. The proof breaks if you don't make this assumption. Okay, so if you go back to the steps, uh, one of the steps entailed purchasing the underlying asset at small t, at time small t, and holding on to the underlying asset until time capital T. So let's go back here. Okay, so here in the first case we've shown, we assume a long position on the underlying asset where you bought the underlying asset at time small t and you held it until time capital T without cost. Okay, so if you cannot do that, if there are costs, for example, associated with holding the asset, then these costs would need to be included somewhere in that line here, and this would break the proof. Okay, so this is why the storability without cost of the underlying asset is necessary for the previous proof to hold. So if storability is not possible, then the previous proof breaks and the strike price might depart from the formula we've shown earlier, which was S small t divided by Z. Okay, so the storability is crucial for the relationship K is equal to S small t over Z to hold. If we don't have storability without cost and indefinite storability, then the previous result might not be valid. Okay, so in summary, what happened? We define forward contracts, and these forward contracts involved what we call the strike price, which was a price at which the transaction would be held in the future. And then when two companies they enter into a forward contract, they need to agree on what would be that price. And we just showed that using mild assumptions, which is the absence of arbitrage, then there was a unique value that made sense for the strike price of the forward contract, and this value is the forward price of the asset, which was defined according to the formula S small t divided by Z small t capital T. Okay, so the assumption of absence of arbitrage, along with some others, so along with storability, they were sufficient to determine in a unique way the strike price associated with a forward contract. Okay, so we've mentioned the storability assumption, but there are other implicit assumptions we've made in our previous proofs. Okay, so we have not yet discussed these assumptions, but these needed to hold if we wanted to set up the portfolios presented in the proof. Okay, so we assume, as we mentioned, that the underlying asset does not pay dividends. We haven't considered transaction costs. So sometimes if you purchase a stock, well, you need to pay a commission, which is a cost. So this was not taken into account in the previous proof. We didn't consider the bid-ask spread. So we said that the price at time small t of the underlying asset is S small t, but in practice there's no such thing as a single price. Okay, so there's a bracket of prices in practice. So bid-ask spread means that if you can always purchase an asset at a higher price than the higher bracket and sell the price at a lower price than this lower bracket. But if you want to do a transaction in between the spread, might not be possible because you won't find any counterparty willing to transact within this spread. Okay, so in practice, there's no single price for an underlying asset. There's what we call a bid price and an ask price, but this wasn't considered in the previous proof. We haven't considered taxes, so if you have to pay taxes when you purchase and sell an asset, these are costs that shouldn't have been included in cash flows. We assume that there would be a possibility to purchase or sell fractions of shares, which is of course impossible in practice. So if you buy stocks, sometimes it's very difficult to purchase a number that is not a multiple of 100. Okay, so sometimes you might be able to, but you will not be able to purchase like a fraction of a stock. So it must be an integer number, and often it comes in multiple of hundreds, for example. Again, we assume no storage costs of the assets, and we assume no constraints on short selling. So in practice, we've talked about short selling, but in practice, sometimes there are restrictions. So for example, there isn't always people willing to lend you an asset for doing a short sale. Sorry. Okay, so if you find nobody from whom to borrow the asset, then you won't be able to short sell. Sometimes there are regulatory constraints on short sale. So for example, the regulators, they might prevent you from short selling some assets. And furthermore, we haven't mentioned this, but usually in practice, when you borrow an asset from a third party, for example, from a broker, there's a fee associated with borrowing that asset. Okay, so this fee, often called a haircut, we haven't discussed it or included that fee in the previous proof. Okay, so all these assumptions we made either explicitly or implicitly during the previous proof, they are not really realistic in practice. Okay, so they don't exactly hold. So for this reason, often in practice, the previous theorem is not exactly right. It's just a good approximation of the reality. Okay, so but sometimes this approximation is good enough for practical purposes. But still, when we apply that in practice, we must remember that there were assumptions underlying that result. Okay, so we've talked about a forward contract. Now we could mention what we call prepaid forward contract. So a prepaid forward contract is a contract where the strike is paid at the initiation of the contract instead of the maturity. Okay, so the regular forward contract entailed that at time capital T, the long position receives the underlying asset and pays the strike. Whereas a prepaid forward contract, the long position pays the strike price at the initiation of the forward contract, so at time small t, and receives the underlying asset at the maturity at time capital T instead of small t. Okay, so in that case, there's a mismatch between the timing of the delivery of the asset from the short position to the long position and the payment of the strike price. So in that case, is there a relationship between the strike price of a forward contract and the strike price of a prepaid forward contract? Well, the answer is yes. Okay, so to see that, we have to realize that paying a certain amount of money A at time capital T is equivalent to paying an amount of money A Z small t capital T at time small t. Okay, so this is due to the time value of money. So the value of an amount of money or amount of dollars A at time capital T. If you want to know the equivalent amount of money at time small t, you have to apply the discount factor. And the discount factor is simply the price of the zero coupon. Okay, so having $1 at time capital T, if you want to have that, you can simply purchase at time small t 1 unit of zero coupon. So in that case, both the price of 1 unit of zero coupon at time small t and $1 at capital T must be equivalent. Okay, because purchasing one can give the other and vice versa. So because of that, uh, the unique price for a forward prepaid contract, which does not lead to some arbitrage opportunities, uh, must have some relationship with the price of a regular forward contract, and this relationship is given by the following. So the price of a prepaid forward contract must be equal to the zero coupon bond value times the price of a regular forward contract. Okay, so because a regular forward contract entails that the strike price was denoted F small t capital T. Well, if you want to pay that strike price at time small t instead of capital T, then the value you should pay, instead of paying F small t capital T at time capital T, you should pay the same amount times the value of a zero coupon at time small t due to the time value of the money. Okay, so this quantity, which is the forward price times the price of the zero coupon at time small t, this is known as the prepaid forward price, and it is denoted by F small t capital T pre. Okay, so pre here means prepaid. Okay, so again, if we use all the assumptions made previously, included the absence of dividends, we saw that this quantity had to be here, this F here had to be ST, S small t divided by Z. Okay, so if we replace this guy by S small t divided by Z, which is done below here, then here the two Z's cancel out, and we see that the prepaid forward contract price must be the price of the underlying asset itself. Okay. So we talked about forward contracts. Now we will talk about another type of contract which are very similar to forward contracts, but with small modifications that were applied to it. Okay, so we will introduce futures contract. And futures contract are similar to forward contract, but somewhat different. So one of the main differences between a forward contract and a futures contract is that for a futures contract, cash flows are exchanged throughout the life of the contract instead of simply at maturity. So we said that for a forward contract, the underlying asset and the strike price are traded only at the maturity date, whereas for a futures contract, let's say you enter in a futures contract right now, there will be continuous exchanges of cash flows until the maturity. Okay, so for the sake of simplicity, we will assume a constant rate of interest. Okay, so here small r will be the constant continuously compounded rate of interest, and this means that zero coupon bond prices, Z, can be written as the exponential of minus the interest rate times the difference between capital T and small t, which is the time until maturity of the zero coupon bond. Okay, so similarly to a forward contract, a futures contract also has an underlying asset, which we will denote S, and a maturity date, which we denote capital T. Okay, so a futures is again contracted on some underlying asset and has a definite maturity date. Okay, so let's consider here uh, a symbol called denoted F small t capital T, but with a bar here. So it's F bar small t capital T, and this is a quantity which we will call the futures price at time t. Okay, so for now we will consider F bar small t capital T to be a given quantity. We won't explain right now how it's determined, but then subsequently, and subsequent slides of this chapter, then we'll provide a mechanism which will explain uh, how this futures price is determined in practice. Okay, so as we mentioned earlier, futures contract, they involve a continuous, well, not continuous, but periodic exchange of cash flows. In practice, it's daily. So daily exchange of cash flows until the maturity of the contract. However, we will assume that if you enter a futures contract at time t0, so let's say t0 here is the initiation date of the futures contract. At time t0, there will be no exchange of cash flows. And then at all subsequent time steps, there will be exchanges of cash flow. Okay, so there will be a continuous stream of cash flows until the maturity date, except at time 0 when you enter into the futures contract. Okay, so again, when you enter the futures contract, there's a long position and a short position to the contract. So cash flows are always paid from the long position to the short position, or from the short position to the long position. Okay, so this is a zero-sum game. One pays the amount to the other and vice versa. So how are the cash flows determined for a futures contract? For all subsequent time steps, t, which are greater or equal to t0 but smaller than t, the holder of a long position in the futures will receive f bar t plus 1 minus f bar t at time small t plus 1 from the counterparty. Okay, so let's take time to analyze this. So at time t0, there's no exchange of cash flow. And then for all subsequent time steps, so let's say you're at time t0 plus 1, then the long position receives f t0 plus 1 minus f t0 from the short position. So the short position has to pay this amount of money. Then what happens? If this guy is greater than this guy, it means that this amount is positive, so this amount is paid from the short position to the long position. However, if f bar t plus 1 is smaller than f bar t, the long position receives a negative amount. So receiving a negative amount means in practice you have to pay that value to the short position. Okay, so this is how cash flows are determined for a futures contract. So at all time steps t, the long position receives f bar t plus 1 minus f bar t at time t plus 1, okay, until the maturity of the contract. So this mechanism here, it's called marking to market. So we're going to give a bit more insight about why we call it this way subsequently. Okay, so as we said, if this amount is negative, it means that the long position pays a negative amount, which means it gives the money to the short position. Okay, this is at all time steps, all time steps except the maturity date. And then what happens at the maturity date, capital T? The long position receives the underlying asset from the short position, and the short position in return will be paid f bar capital T capital T. Okay, so at the maturity date, the cash flows are the following. The short position gives the underlying asset to the long position, and the long position pays the terminal futures price, F bar capital T. Okay, so now we've explained what the cash flows are, but how can we make sense of these cash flows? What is the intuition uh, with respect to these cash flows? Okay, so why do they make sense? So if you're a long position, if you have a long position on the futures contract, let's investigate how much money in total you will have received. Okay, so right now we're going to purely disregard the time value of money. We're just going to sum cash amount through times and not accrue interest on them. Okay, so in total, if you're the long position, at the maturity, you've received the underlying asset and you paid the terminal futures price, and plus you receive for all previous time steps the variation between uh, F bar J and F bar J minus 1. So these are cash flows you've received for all previous time steps. Okay, so if you do that, you can notice that the second sum is telescopic, which means that all the successive terms, they cancel out each other, and what remains at the end is simply the last value of the last term of the sum minus the initial value or initial term of the sum. So this summation here, it can be expressed as F bar capital T minus F bar T0. Okay, so here you can cancel out this F bar capital T and this F bar capital T. So it means that in total, you have received between times small, this should be T0, so sorry about that. This should be a T0 and this should be a capital T. You have received in total S small t minus F bar T0. Okay, so you can see that the futures price, it acts a bit like the strike price, because in total, if we disregard interest and time value of the money, at maturity, the long position on the futures contract will have received ST, the value of the underlying asset, and will have paid FT0 capital T, which was the futures price at the time the contract was initiated. Okay, so we see that if we disregard the time value of the money, the payoff of a futures contract would be the same than the payoff of a forward contract, which is the underlying asset value at maturity minus the initial futures price at the onset of the contract. Okay, so recall that for a forward contract, the payoff was of this form. It's ST minus FT0 capital T. So the only difference here is the presence of the bar. Okay, so for a futures contract, you receive ST minus the futures price, whereas for a forward contract, you receive ST minus the forward price. Okay, so the payoff is different because one is F bar, the other is F. But the other difference is that for a forward contract, this amount you received exactly at the maturity date, whereas this amount for the futures contract, this is the sum of cash flows received across multiple dates in the existence of the futures contract. Okay, so in practice, because some cash flows are received before the maturity, if you want to understand the value of all cash flows you've received from a futures position, you must accrue interest on them. Okay, so if you accrue interest on all payments received before the maturity capital T, and you've accrued interest from the time you receive the cash flow until time capital T, then the future value of all cash flows received from the futures contract are the following. So this is the value, the cash flow at maturity time capital T. So you accrue no interest on it, and these are all cash flows received previously in previous time steps than the maturity. So all these f bar j minus f bar j minus 1, which are the cash flows, must be multiplied by this interest rate accrual factor, which is the exponential of the risk-free rate minus the time difference between the maturity of the futures and the time at which you receive the cash flow. Okay, so recall here for this example, we consider deterministic interest rate here. Okay. Now we will discuss the notion of closing a futures position. Okay, so sometimes in practice, you can enter a futures contract and you have a continuous exchange of cash flows. And at some point, you might decide, okay, I don't want to pursue this exchange of cash flows. I want to end the contract at some point in time. Okay, so this is called closing a futures contract, which is discontinuing the continuous exchange of cash flows until maturity. Okay, so how this is done in practice, closing a futures position is done through entering the opposite position you're in right now. Okay, so if you're in a long position in a futures contract, then at some point in time, you might enter a short position in the futures contract, and then cash flows from the long and futures positions starting on that date where you entered the opposite position, they will offset each other at that date until maturity. Okay, so if you do that, you choose to close a future at some date, small time called a time small t f. Then at this time small t f until time capital T, the fact that you have two offsetting positions, they will lead to a net cash flow of $0. Okay, so in practice, when people enter a futures contract and at some point they want to leave that futures contract, they just enter into the opposite position, and this is said to close the futures position. Okay. Now we will introduce some considerations related to what we call margin accounts. Okay, so one question is, we saw that if you enter a futures contract at some point in time, it requires immediately zero exchange of cash flows. Okay, so the question is, can you enter in a futures contract without having any money? Okay, so in practice, when you enter a futures contract, typically these contracts are centralized. Okay, so what happens is businesses which want to enter a futures contract, so let's say you have a short position and a long position, they don't enter into a short and long position directly against each other. There's usually what we call a third party with which each of the institutions transact, and this third party, which is called the clearing house, so it's often an institution associated with a financial exchange, for example. Okay, so the clearing house acts as a counterparty to institutions who want to enter futures contract, and this clearing house, it's responsible for the exchange or for processing the exchange of cash flows that are made daily between the two parties. Okay, so cash flows occurring due to futures contract are processed by that clearinghouse. Okay, so in practice, you could think that anybody could enter a futures contract because as of time t0, nobody needs to do some cash flow to enter a futures contract. However, when you enter a futures contract, you will have subsequent cash flow exchanges in the future. Okay, so to be able to provide payments, if you have payments to do, you must have some reserve of money to able to do the payments in the future. Okay, if you don't have reserves of money, then uh, as some payment is due to the counterparty, you will not be able to do it. Okay, so typically when clearinghouse they match institutions, so they identify a potential short position and a long position, and they match them together. They must ensure that each of the positions, so each institution, have a minimum amount of money in reserve to be able to uh, they so that they will be able to take the money from this reserve to do the payments as they are due throughout the life of the futures contract. Okay, so this reserve of money is deposited by both parties into what is called a margin account. Okay, so the margin account is the account in which the money is taken or the money is deposited every time a payment is due from one party to the other due to the futures contract. Okay, so each firm that enters into futures positions, they have their margin account. So they have an account in which they deposit money, and if a payment is due to some other counterparty, then the clearinghouse will pick money from that account and give it to the account of the counterparty. Okay, so this is the margin account. Now we will introduce the concept of margin balance. So the margin balance is the current balance of the margin account after all money transfers were made due to previous movement of prices of the underlying asset. Okay, so the margin balance simply means how much money do you have left in your margin account. Okay, so um, again, these concepts is just to give an overview of how these things function in practice. Okay, so we talked about futures contract. It's good to have a knowledge of associated terminology and associated concepts with these contracts. So in practice, if you work with futures contracts, you need to know what these terms are and how payments are processed in practice. Okay, so in practice, the clearinghouse, which processes payments between the counterparties of a futures contract, they must ensure that at all times there's a minimum amount of money left in the margin account. Okay, because if there's no money left and some counterparty has a payment to do to another one, then the initial party will not be able to do the payment. So the clearinghouse ensures that at all times there's a minimum amount of funds in the margin account of each counterparty. So this minimum is called a maintenance margin. Okay, so if the margin balance of a participant falls below the maintenance margin, because let's say the futures price varies through time, so one party has to do payments to another counterparty, and because of that, the value of its margin account falls below the minimum level, then the clearinghouse will issue what we call a margin call. So margin call is a call of for future funds to be deposited in the margin account of some party transacting into futures contract. Okay, so in the case of a margin call, the clearinghouse will require the party which has insufficient funds to deposit additional funds immediately in his margin account, and if the participant is either unable or unwilling to provide such funds, then his futures position is terminated, and by terminated I mean closed immediately. Okay, so this is why we discussed closing a futures contract. It's also because in practice, when you have a futures contract and you have two parties to that futures contract, if at some point some of the party doesn't have sufficient funds to guarantee they will still be able to provide payments to the other party, then his futures position will be closed automatically by the clearinghouse. Okay, so this is a kind of a security mechanism to ensure that uh, if payments are promised to you from a futures contract, that these payments will be met in the future. Okay, so I propose to end the first video now. We'll continue next with the second video. We will discuss the pricing of futures contract. So how is the futures price determined in practice? And then subsequently we'll introduce other types of financial derivatives in future videos. So thank you.